Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, and we're going to discuss it as a function of the money supply. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the Into the Equityverse Telegram channel, which you can find a link to in the description below. Let's go ahead and jump in. So the S&P 500, the stock market in general, but we're going to specifically focus on the S&P 500, it's sort of known for generally going up, right? There are periods where it goes down, like we saw after the dot-com bubble and after the financial crisis, and you can go back and look at plenty of prior bear markets and note all of the times that it went down, okay? We can see this it's happened many, many times. However, over decades and decades, it does have a bullish bias, does it not? Right? It does. Even if you look at sort of the lost decade of the 2000s, where the S&P more or less just went, I mean, it dropped 50% twice, but you could argue it was just mostly sideways if you don't care about those 50% drops and 2x moves. Sort of just like a bull market bias, right? And it still was a generally going up with time. But another way to look at this that I think is more interesting is to account for the money supply, because the argument, right, is that maybe the S&P 500 goes up, not always just because the companies are fundamentally worth more. Maybe there's just more money in the system. Maybe if we print trillions and trillions of dollars, that will cause inflation, which will lead to higher asset prices, even though you could argue they haven't really changed much fundamentally. There's just more money in the system, therefore they're worth more. Okay? But that means that essentially everything is going up. It's not just that asset, but everything in our lives. We're seeing inflation, whether it's food or energy, whatever it may be. This is something that we constantly have to wrestle with. So, yes, over the macro scale, does the S&P 500 go up? Yeah, it does. Does the money supply go up as a function of time over the macro scale? Yeah, it does. If you zoom in, you notice that it's actually leveled off here a bit recently in 2022. Okay, it has started to level off, but it does generally go up with time. So then it raises the question, is the stock market going up because the company is worth more fundamentally, or is it just going up because we're just printing a lot of money? Well, if you go look at the S&P 500 divided by M2, the money supply, this is what you get. And what you'll notice is that there is not a clear bullish bias. There is not. I mean, we could look at the 80s and say this was a bullish bias to get us into sort of this range that we've been in for a long time. But if you look at, say, where we've been for the last 30 years, we have mostly been in a very specific range for the last 3 decades, okay? So this is the S&P 500 divided by the money supply. And you can see that over the last several decades, we have been in more or less the same range. Now, there are some interesting things about this that some recurring themes. One of them is that this area, about 0.22 or so, tends to find some resistance. Even as we went into the dot-com bubble, we found some resistance at that level. When we had sort of a dead cat bounce in the bear market of 2000 to 2002, we even had a dead cat bounce back up to this level. We came back up to that level as well in 2007 before the financial crisis. We came back up to this level in 2020, right before the pandemic. We also came right up to this level, slightly above it, in late 2021, right before the Fed pivoted and started combating high inflation. Okay? So this level has showed up multiple times. What you'll notice is that every time we got up to this level, we did not hold it for very long. Okay, we did not hold it for very long. We ended up coming back down. To be completely honest, the first thing I look at when I see this chart, I see the dot-com bubble, and I can't help but think just how crazy it was. I mean, I as a kid, I grew up in the 90s. And I remember getting into the 2000s and the internet really becoming a thing, and a lot of kids were using it, including myself. But I didn't really experience the financial side of it. Look how crazy that was, right? compared to the money supply. I mean, this was a fairly major bubble. It also just shows you how much bigger of a bubble with respect to the money supply that the dot-com bubble was compared to what we've seen anytime recently. And in fact, for us to have gone up to dot-com valuations, we would have had to see another 47% increase in asset prices to have actually reached that point. Another 47%. Okay, so basically another 50% or so. So, had we seen another 50% increase, I mean, obviously the S&P would have gone. I mean, from where it ultimately peaked, if we were to take, say, like a 47% move or something from where it ended up peaking, I mean, that would have put it at close to 7,000. That's how crazy the dot-com bubble was with respect to the money supply. With Bitcoin, I mean, it would have put it over 100K had we gone up to those same types of valuations. But we didn't do that, right? I mean, the Fed pivoted. They started QT, right? They started raising interest rates. And therefore, don't fight the Fed, right? When we came back down, don't fight the Fed. This is the general argument, is that it's not a wise idea to fight the Federal Reserve. But again, you see these main points that anytime we come up to these levels, we tend to find resistance. We also see some level of support at around 0.14. We got some support here a couple times back in 2002 and 2003. We also found this as support during the drop after the pandemic started in March of 2020. And then, of course, we also found some resistance getting into this range back in 1994. So this is an interesting chart to look at. The S&P, with respect to the money supply, has simply been an oscillator for the last 30 years. Now, that doesn't mean we won't eventually break out into a new range. You can see at one point we were all the way down here and we sort of broke out into this range. At some point, I would imagine we'll break out into another range. Do we have to come back down here first? I don't know, right? I don't know. If you look at this as just sort of like deviations, you could say we've been in this range for the last 30 years with one deviation to the upside, which was the dot-com bubble, and one deviation to the downside, which was the financial crisis. And ever since then, the bull markets and the bear markets have been fairly well defined in this range, right? I mean, yes, we have had two deviations, but they've been fairly well defined in this range. Another thing to consider, the S&P 500 bottomed at more or less the same price in 2000 and 2008, right? Now, you might say, well, it went a little bit lower in 2008, 2009. Yeah, I did. It was a wick. No one's getting out of bed for that. But we more or less bottomed at around the same price, right? Like the level was essentially on the S&P 500. You can see it more or less bottomed at around 800 or so both times, with slight deviations to the downside. What's interesting, though, is that despite the fact that the S&P 500 against the US dollar bottomed at around the same level in the financial crisis and in the dot-com crash, with respect to the money supply, the deviation was much worse in the financial crisis. So the bottom was a lot worse, and that's arguably why it felt a lot worse. I mean, as a function of the money supply, it was down a lot more. And we had already seen, a rather extensive bear market from 2000 to 2002. So to just go up for a few years only to revisit those prices and go slightly lower, think about how that must have felt for investors, right? It would not have felt very good. But we had this sort of deviation to the downside in the same way that we had a deviation to the upside. So we have talked a lot about the S&P 500 bear market, the one we're currently experiencing. We're looking at it and saying, all right, well, here's a 2022 bear market. Here are some other bear markets that seem somewhat similar. Could it continue to drag on for a while? It could. Especially if you compare to the financial crisis, if you compare to other periods of high inflation like 1973, 1974, 1980, 1981, or 1982, also the dot-com bubble, you can see there's plenty of reasons that would suggest that we could see the bear market continue for a good bit longer, even if it doesn't have to go that much lower, like the 1980s, where it didn't go that much lower, but in other cases it did. Either way, there's a good chance that the S&P 500 will remain in a bear market for a while longer as the Fed continues to remain hawkish, as inflation still is an issue, and as long as there's going to be this sort of fear of rising unemployment and an upcoming recession, This is going to just be something we have to live with. However, if we do get something like that and the stock market does eventually take, say, like some type of a plunge, and we come back down to this level over here, we should be aware that that has offered strong levels of support in the past. And that even if there is some future deviation to the downside, it might come after a future bull market. If you had assumed that in 2002 that it would have had to deviate down here, which would have represented another 42% drop, and you did not put any money in 2002 because you thought it was going to keep going, you would have eventually been right. But would it have been worth missing out on a 2x gain? This was a 2x gain, right? If we take the move here from the bottom to the top, this is about 100% or just over 100%. So yeah, maybe you would have been right in the end, but you would have also been the schmuck that wouldn't have bought in 2002, and you'd have just seen like this sort of bull market play out, and you didn't take any part of it. And is, could you have held off from 2002 to 2009 without buying and just, waiting 7 years? I don't know, probably not, right? I don't think I could. So it does of course show some good parts of say dollar cost averaging into the market, right? You just sort of admit you don't know exactly what will happen, and you just write it. And if it gets overvalued, maybe take profits. If it gets undervalued, maybe you get a bit more aggressive in your accumulation. But that's something to consider, because let's suppose there is another pullback in the S&P 500. Look, if it goes back down to the level that it went back in March 2020, it would mean about another 18% drop in the S&P 500. From the current prices, another 18% drop. Guess where it puts it? It puts it right around 3,000. Okay, so we need to be somewhat cognizant of this. If we come back down to this level, and let's suppose that the Fed, we'll say we're in a recession, and we know we normally bottom during a recession, and the Fed has pivoted, and we're coming out of the recession in, say, 2024 time frame, we could have another bull market. Maybe it doesn't go up to .com valuations, but maybe it's just another bull market, right? I'm going to say this now. I think there's a good chance, and I can say it because it might not happen for 20 years, and I'll probably forget that I said it anyways. But I think at some point we're gearing up for another phase of economic expansion. And by gearing up, we're still in the down part of it. We're not really gearing up for it. We can kind of see it in the future though, right? Like you could let's fast forward several years. Inflation's back down. Hopefully we have our supply chain issues sorted out. Hopefully war isn't as much on the agenda as it is right now, especially with what's going on in Russia and Ukraine. We can sort of imagine a period of economic expansion once we get back on track. And the .com bubble sort of led into this, right? Digital assets, I think, could be a reason why. I probably lost a lot of you right when I said that, right? If you don't like crypto. But yeah, maybe that'll be the next phase of expansion where we go up to a new paradigm shift, and then we go into a new sort of range bound area for a long time. But it's not really here nor there at this point. I just want to put that thought out there that we are sort of stuck in this range. We've been stuck in this range for a long time. We'll probably still be in this range for a while. But if we fast forward out to the 2030s, I see no reason why we can't have another a push much higher to a much more much higher levels is what I want to say, much higher levels. But until, I think that's still a ways off. We probably still have to play in this sandbox for a while. Whether we have another deviation down here or not is I guess is anyone's guess. But I do think these are some important charts to look at. It's the responsibility, I think, is that as an investor, you don't just want to invest in general to make sure you're growing your net worth. Sometimes you need to invest, or it makes sense to invest just to keep your net worth the same because of the value of it, or the the debasement of fiat currencies with high inflation. So that's just something to consider. If the money supply is going to go up and you don't figure out ways to invest your money, then you basically know that your purchasing power goes down. If you do invest in risk assets at good points, then then at least you have a chance to outperform inflation. And I've said all year, cash is king. So I'm not. I mean, like I fully recognize. This year I've said many times that cash is king, but it's not going to always be king. That's the important thing to remember. It's not going to always be king. There will come a day where it will no longer be king, and risk assets will likely rule once again. And I think it's really time to start paying attention if you haven't paid attention to these markets. I do think 2023 is going to provide a lot of good value buys. Not just on the stock market, but crypto as well. I think 2023 is going to provide a lot of, much better value buys than it would have in 2021. The funny thing is most people who were buying in 2021 probably no longer even watch this channel now that we're in 2022 and getting closer to 2023. But these are important considerations, I think. And hopefully this has been somewhat insightful, looking at sort of this range-bound area with the stock market divided by the money supply, and hopefully we can use it as a tool moving forward to better navigate financial markets. If you guys like the content, make sure you subscribe to the channel. We also do have Into the Cryptoverse Premium at intothecryptoverse.com. Thank you guys for tuning in. I'll see you next time. Bye.